The changing nature of event risk. Event risk is changing in very important ways for risk managers. And what we have observed is that there are three distinctive phases of event risk that have occurred since the Great Recession of 2008. So we'll take you through these phases and then draw some conclusions. So phase one. Phase one is what we call the central bank put. This is where the Federal Reserve is doing quantitative easing, interest rates are at zero, it was essentially 2011 to 2015, but there really wasn't any event risk, even though there were critical events. There were events like the S&P downgraded U.S. government debt. There was the Greek sovereign debt crisis. The Federal Reserve made its first rate hike in December 2015. These were serious events, but because the markets were so sure the Fed had their back, what we call the Federal Reserve put, it was really a buy the dip and keep on trading period. Now the next phase, which we entered in 2016, is a phase which we call known dates and unknown binary outcomes. This was all about politics. You had the Brexit vote. You had the US presidential election of November 2016. You had the UK snap parliamentary election of June 2017. These known date, unknown outcome events are mostly political, and all the action occurs the day after you find out the answer. So you have a couple of really big days in which they're very volatile, they have price breaks, and then after that it calms down. Now we're now in a third phase. And this phase is very interesting because this third phase is about extended policy debates that have binary outcomes. We no longer know the date of the decision. We just know a decision has to be made. So we have the US-China trade war. It's ongoing, but we get news all the time, but no resolution. The Brexit negotiations, boy, this has been a saga, but it should end in March of 2019. And then we have Fed policy. Are they going to keep raising rates like we thought they might, or are they going to halt in 2019? These are all unknown outcomes where we don't know the date, we don't know the outcome right now, but eventually we will know the outcome. And what that means is that traders have to evaluate the shifting probabilities every day. And one of the things that's caused is when you get a piece of news that causes a probability shift, well, you get a price break, a very quick, sharp price movement. And that means that risk managers in this third environment have little choice but to adopt dynamic risk management strategies. They're incorporating a mix of direction-based hedges, often futures. Then they have to worry about a volatility regime shift or a price break shift. And those are often involving option strategies, but it's an extremely complex set of divergent market outcomes that require sophisticated risk management. I'm Blue Putnam, Chief Economist, CME Group.